And one word in particular is making its way back into the headlines recently that must give us pause: subprime. Those type of loans, so prominent in housing ahead of the crash in 2007, may be seeing a comeback. And this time they are in the auto market. A stunning investigation by the New York Times found that subprime auto loans are on the rise, and they are exhibiting predatory tendencies. According to the New York Times report, auto loans to people with tarnished credit have risen more than 130% in the 5 years since the immediate aftermath of the financial crisis, with roughly 1 in 4 new auto loans last year going to borrowers considered subprime. Joining me now is David K. Johnston, contributing editor at Newsweek and professor at Syracuse University College of Law, and Avik Roy, who is senior fellow, Manhattan Institute, and opinion editor at Forbes. So nice to have you both here.
Thanks for having us.
Okay, so if we are back in the land, potentially, of subprime, let's go back to the big fight that occurred around the crash, which is, who is at fault here? Bad borrowers or bad lenders?
I'd say bad lenders, but I'd say it goes back even further. The untold story here, the big untold story, is the degree to which monetary policy from the Federal Reserve, Ben Bernanke and Janet Yellen, have driven this situation. So your New Yorker piece that you talked about says, why is Wells Fargo, say, able to package these loans and sell them to other investors? Why would these investors buy these loans knowing that they're subprime? The reason is that interest rates are so low, 0.25% by the Fed, that if inflation is 2%, as a bond investor, you're losing money every year by sitting on the cash.
I feel like what you just said to me, and maybe this is so if I'm being unfair, but I feel like what you said to me, these poor investors are basically, starved for profit. So of course they've got to make some bad loans in order to get their money back.
Not at all am I saying that they're poor, but what I'm saying is that the economic incentives that they've been driven to have by the lending environment, by the interest environment, is driving them to seek higher risk loans, which is the catalyst of this whole process.
And Avik, that's where I would agree that you're right about the effort to see higher risk loans. But let's remember, car lending was exempted from the Consumer Protection Act.
Right, because Avik, I appreciate that part of what you're saying there is, okay, it is an incentive environment, right? And this is part of your point about regulation. How do we change the incentives in an environment?
Exactly.
Well, we create new regulations. So from my perspective, raising interest rates, which would further harm buyers, particularly those who are trying to get into a housing market where each incremental increase is substantially larger than on an auto loan, would be so harmful for buyers that it would be bad for the economy, even if it would yield more for investors.
So I look at the exact opposite way.
Okay.
So when we have low interest rates, what we're doing is encouraging people to borrow money, perhaps more than they need to or more than their means. And what that's also doing is driving up, as you said, in the mortgage market, it's driving up demand for gigantic mortgages, for mega houses, driving up demand for housing supply, but the housing supply is constant. What does that do? Housing prices are more expensive. It becomes more expensive to buy a home. It becomes more expensive to rent a home.
But that hasn't been what's happening
with housing. The housing market has been very strong.
But we've been regulating banks and banking for 4,000 years. It's only somehow in the last 30 that we've gotten this idea that, oh, these people, they know what they're doing. We don't need to regulate them. Yes, we do.
They've been pretty heavily regulated. I don't think it's not that they've been heavily regulated.
But not in a way that's meaningful. Not in a way.